Okay, looks like should be good here. We can, there we go. Okay, I think Dad, Steve, I think we're good to go.
You know, we're kind of like that duck on the water. We look really peaceful on top right now, but up until like 30 seconds ago, we were having all sorts of technology issues. But anyway, I think we are good. Welcome, everybody. I'm here in Oklahoma City where we are still reveling from the Thunder Championship and celebrating the fact that we've had 24 hours without any rain. So, with all of that said, we're glad everybody's here today. I'm going to introduce Dan Rudolph. He is with Jackson National. They're one of our investment partners. And of course, that was Jamie Kaestner that led us off. And Jamie's coming to us from almost downtown Minneapolis. I guess it is downtown Mound, is I guess where you are now,
Yeah,
right?
we have a heat advisory today. I think we're gonna hit 90, so everyone's kind of panicked here.
Well, I guess it's okay. Winter's just around the corner for you. So, Mr. Dan, can you kind of lead us off and tell us what all we're going to do today?
Yeah, no, I appreciate the opportunity, Steve, and I appreciate the partnership from you and Jamie as well. As I mentioned, I'm just a local wholesaling partner or a partner with that partners with them. So Kelly Hill is going to be really the belle of the ball when it comes to this webinar. It's not about what you know; it's who you know. And Kelly is vice president for Jackson of our portfolio specialist team. So she's inundated with markets and information and kind of what's going on, big beautiful bill, of course. But Kelly's been with Jackson for 14 years, longer than I have. Prior to that, she was a portfolio manager at Sentinel and then Putnam Investments and at Wells Fargo. So she's got the resume, and I'm going to give her as much time as possible. I'll share my screen to show the deck, but Kelly, I'll kind of let you take it away. But if people have any questions, feel free to toss them into the chat or ask them as we go. We want to keep this more of a conversation, but I do have some questions at the end as well if needed. So Kelly, I'll let you start right there.
Oh, great. Well, thank you so much for joining us today. We are going to talk a little bit about the capital markets and certainly what happened in the first half of 2025. As you heard from my resume, I have been in the investment services industry for quite a while and seen a lot of different markets. But I think this year and this first half was to say the least, interesting. And we certainly started off with a bang and hit an all-time high for the S&P on February 19th. It was then we started talking about, or really President Trump started talking about um, negotiating trade deals and tariffs and et cetera. And in the first quarter, the market declined by as much as 8 or 9%. But it was really a lot of the fireworks happened come Liberation Day, which was April 2nd. And President Trump had the honor of announcing sort of what the potential tariffs and trade negotiations would be. Well, the market didn't necessarily like that. And in fact, we had 2 days of back to back declines of 4% each. So the market was down another 8%. And in fact, by April 8th, it actually reached what we often call bear market territory, with the market being down as much as 19%. The NASDAQ was down as much as 24%. And if you blinked, though, you kind of missed that bottoming out of the market, because from April 9th, when President Trump announced the pause, it was nothing but straight up for the balance of the quarter. So the title of our market review and outlook this quarter is diversification. And while diversification over the last 2 years, 2023 and 24, was rather challenging, given the fact that a lot of the return for the S&P came from a very small number of names, today diversification not only helped you manage risk, but also return. Next slide, please. Right. Okay. All right. Um, we're just going to spend a minute, if that, on the next couple slides, really showing you the depth and power of Jackson National Asset Management. We're 250 billion in assets under management with 134 different choices on our investment platform. Next slide, please. This makes us the 14th largest investment management shop in the US. Quite an impressive list to be a member of, but as you can see, we do have some clout where investment management is regarded. Next slide. We have a dedicated investment management team with 20 individual participants who have an average of 19 years of experience. Next slide, please. That we are supported by our due diligence process. This is something that we use to put sub-accounts or strategies on the platform, maintain them on the platform, and more importantly, remove them from the platform. It includes things like performance, the elements of the strategy itself, how decisions are made, how stocks are picked. It's the oversight that each one of our analysts conducts on a quarterly basis. It's also about having diversification at the platform level so that all sub-accounts don't look or act alike. But lastly, it's also about the operations of the organization that also is important. You know, you can have a great strategy, but a horrible firm. And so that comes into play and is actually supported by a completely different team. We all come together and we rank each one of the strategies on a quarterly basis. Next slide, please. This allows us to provide not only best of breed individual strategies, but also a full suite of asset allocation solutions, whether it's our own risk-based asset allocation models, manager specific, which includes American Funds and Vanguard, two very recognizable names, or even our multi-manager solutions with different asset classes. When we look at, next slide. So when we look at the quarterly recap and what happened in the second quarter, as I mentioned earlier, markets rebounded following the initial tariff announcements. And what we know now is that it was sort of a go big or go home approach with the ability to then negotiate. And I think that's what we will continue to experience for the balance of the next 4 years, that in fact, it is all about the negotiation and the deal. But I think what is even more important, other than trade talks and inflation and all the things that we worry about when it comes to capital markets, I think one of the most important things to keep in mind is that the success was in staying invested and not letting short-term news dictate our long-term investment decisions. As I mentioned earlier, if you had blinked, you would have missed the bottom of the market for what we think is the year. And we've got a great slide in the deck to show you. But it would have been very difficult to try to get back in when the market in a very short period of time not only retraced all of the drawdown, but actually on the last day of the second quarter and the last day of the first half of 2025, it hit an all-time high. Other things that happened in the quarter were certainly the weakening of the US dollar. And in fact, we have never seen, or dating back quite a long time ago, 1973 to be exact, that the dollar has had the worst start to the year. Coming into the year, the dollar was very strong and has certainly weakened considerably over the balance of 6 months. And that has certainly helped fuel the outperformance of international strategies, both on the developed side and the developing side. And we think this is one of the other important elements to the second quarter and to being successful and navigating a lot of the uncertainty, and that is diversification. So being diversified to US versus international, large versus small, and certainly growth versus value. And then the other important element of the quarter were earnings. So many Wall Street analysts got very cautious, especially in light of what the potential of tariffs could mean for earnings. And the expectation was for earnings to grow at or around 7%. Once earnings season was over and all companies had reported, that earnings number was 14%. So this represented the second quarter of double-digit earnings for the S&P. But we do continue to see many corporate CEOs remain somewhat cautious as to what will eventually be the terminal and effective rate for tariffs. Next slide, please. When we look at capital market performance, and we've outlined here all of the major indexes, you have the S&P, and the light colored bar is the quarter and the darker is represented by the year-to-date return. In the quarter, everybody performed fairly well. Actually, there was all positive performance, with certainly the S&P being up almost 11%, but the international, as measured by the MSCI EFA, was up almost 12, and emerging markets the same. Next slide, please. When we look at sectors, for the balance of last 2 years, it was really technology, communication services, and consumer discretionary, all leading the way. In the second quarter, we actually saw that broadening out, and other names actually outperformed, and other sectors, including things like industrials, where the largest industry within that particular sector is aerospace and defense. Communication services was once again driven by Facebook and Google. And consumer discretionary, while it did have a good second quarter, as you can see by the light colored bar, for the year, it was the year to date through the first half, it was the worst performing sector. And that had a lot to do with the second biggest name in that sector, Tesla. Next slide, please. When we think about styles and returns, we can see for the second quarter, it was all positive and in the green, with once again, large cap growth being the best performing style and market capitalization. Even for the year, the chart on the right-hand side, most was positive except for the lagging small cap. And this has been a difficult year for small cap, but I will say that as the market continues to go up, small cap does appreciate and participate. In fact, year to date, the S&P 600 is only down 1%, coming from down as much as 10%. Next slide, please. So this was the slide I was referring to earlier on. And I think what is so important about this, and oftentimes we ask the question, what do you first notice? And the thing that's most important is that there are way many more bars above the line than there are below the line. In other words, dating back to 1995, the market outperforms about 80% of the time. But even more important is that you notice there is a red dot in every single time period. Now, the red dot represents intra-year declines. And as an investor and as someone who invests in the equity market, one should always expect a handful of drawdowns. In fact, typically, the expectation is for the market to have at least two, sometimes three, 5% drawdowns, one correction, which would be a 10% drawdown, and about every 18 to 24 months, a bear market drawdown, which represents about 20%. But what's most interesting is that you can go back and I was actually managing a large cap growth portfolio at the time in 1998. And just take a look. I know this is small, but that the intra-year drawdown was over 19%. And I remember this like it was the back of my hand because that occurred in the fourth quarter of 1998. In that very short period of time, so down 19%, look at where the market finished up. It was a move of almost 42%. So if you would have gotten out of the market, you not only would have missed the move back to the mean, so the 19%, but the additional move of almost 28%. So again, it pays to stay invested and stay the course. Next chart, please. Volatility. I'm sure you have heard in the news some of the commentators talking about the VIX. What is the VIX? Well, the VIX is actually what they call the Chicago Board of Exchange Volatility Index, fondly named the VIX. This measures expected volatility, or as some investors, traders, and portfolio managers like to call it, the fear gauge. So you can see that markets have been volatile over different periods of time. And the two I would point you distinctly to are, of course, 2008 and 2000 or 2020, where the VIX got as high and above 60. In based on Liberation Day, the VIX actually traded up to almost 40. Now, this was, again, what investors expected. And so often when we do see these very significant spikes in volatility, markets, and that's what the lower bar chart is, actually outperform on a 6, 1 year, 2 year, and look at the significant outperformance of the 3-year number. Once again, and I can't say it enough, the only way to benefit from this is by staying the course and staying invested. Next slide, please. But one important thing, and we talked about this a little bit earlier on the first recap slide, and that was earnings. You know, you can talk about all kinds of different things, and certainly investors have a wonderful way of building a wall of worry, whether it's concern about inflation, taxes, tariffs, geopolitical, inflation, you name it. But at the end of the day, it's always earnings that drive long-term stock prices. And we do expect earnings, as you can see, in 2025 and 2026, the gray bars to the far right, to continue to accelerate. Even in the more cautious tone that CEOs have taken, and certainly the expectations of Wall Street analysts, we think that, for example, the second quarter of 2025, expectations are for earnings to only grow at about 5%. The lowest quarterly estimate that we've seen in 2 years. We think that's a very low bar and will surprise to the upside, very much like it did in the first quarter. Next slide, please. The other highlight of the second quarter, and really began at the beginning of the year, was the relative outperformance of the international stocks to the US. We think this absolutely continues. In fact, today, the outperformance is almost 11 percentage points. The MSCI EFA, as of the end of yesterday's close, was up 19% versus the S&P of up about 7%. Now, this is certainly being driven by a number of things, but probably the two biggest factors to this outperformance have certainly been that weaker dollar. And that really works as a tailwind to international performance, specifically developed international. But it also is about valuation. And Dan, if you go to the next chart, we can see certainly the dollar has declined pretty significantly. So this is really a look at the dollar over the last 10 years. And the decline has been rather dramatic in a very short period of time. And then the next chart speaks to the valuation. And you can see that the valuation is not only attractive relative to the S&P, which is still trading at about 22 times, but also attractive to its own historical multiple. And what's interesting, and a fact that many may not know, is that actually international stocks have a higher overall dividend yield. So they actually do return a lot of their free cash flow back to their shareholders. So dividends actually are typically higher than that of the S&P, and we think that's important in today's market of uncertainties. Next slide, please. This is talking about then equity valuations across many different asset classes. As you can see, the market, the S&P over there on the far left, is still trading at about 22 times at the outward of its historical multiples. But if you move to the far right, you can see where international, both developed as measured by the MSCI All World and the EFA, are both trading at not only discounts to the S&P, so inexpensive relative on a multiple basis, but also very close to what their median multiple has been over time. So again, we think valuation for international is still very attractive, even though we've seen a lot of the strategies move and outperform the US to date. Next slide, please. Fixed income, switching gears a little bit to other asset classes. This is actually a slide that also shows valuation of fixed income. So the bigger the spread, and that's what this is depicting, the more attractive fixed income does appear. Now, there are several sectors within fixed income that are probably fairly valued, including things like high yield and emerging market debt, but still opportunities in the overall bond market, as you can see to the far left, and even on the corporate side. Next slide, please. So when we think about the GDP, or the domestic growth of the economy, the Atlantic Fed always puts out a quarterly expectation. Now, for the first quarter, we did see a decline in GDP of about 0.3%. And most of that, we do have a breakdown of what GDP is. Most of that was due to net imports. However, for the second quarter, as we saw many companies sort of stockpiling ahead of any implementation of tariffs, we're actually expecting the second quarter GDP number to come in at about 2.9%. Now, this was a number that was as of June 30. So again, a fairly strong number for the second quarter as measured by GDP. Now, if we look at the next slide, we will see the breakdown of GDP, and you can see the different components. As I mentioned earlier, one of the causes for the decline in first quarter GDP was due to net exports. And part of the expectation for that 2.9 is change in private inventories, whereby people have sort of ordered more than ahead of the implementation of any tariff. Next slide, please. Another thought that is front of mind for most investors and or clients, and sometimes in very different ways, is inflation. Now, it was just 3 years ago that inflation, as measured by the CPI, was as much or if not more than 9%. And it has significantly come down. And in fact, we got the June CPI reading out just this morning, and it was better than expected. So the headline number came in at 2.7%, slightly up from the May number. And that includes very volatile factors like food and energy, gasoline, but also the other measure of inflation, headline, which excludes those two volatile factors, was actually down less than expected. So that is well under 3% today. Now, I know many of you are thinking, well, what's she talking about? Inflation being down, inflation being down. Well, yes, it is down from the very high levels that we experienced back in 2022, but costs are still up. So when you go to the Publix or when you go to the grocery store, yes, things are definitely much more expensive than they were, let's say, 5 years ago. But the rate of inflation is coming down and coming down every month. In fact, this has been the fifth month where inflation has not ticked upwards. Next slide, please.
Do you see that trend continuing going forward?
I do. I do. It is a little bit of an unknown. That's a great question because one of the things that could impact inflation are tariffs. And the reason and the way that would impact inflation is that as companies have to pay this additional tax or these higher costs to import goods from other countries, they will have to find a way to pass those on, right? They don't want to take all of those expenses on themselves, and they will do it by passing those along to consumers, which then can equate to inflation and increased prices. We think that there may be a combination of pass through to the consumer and companies perhaps taking a little bit in their own margin so that it won't be to the extent that I think was initially sort of expected. So if we, in the absence of no tariffs, we do continue to see inflation come down and work towards that 2% goal. But because of this new sort of wrinkle in the economy with these additional tariffs, it may be challenging. So when we look at Fed funds rate expectations. And this is what they call the dot plot. And you may have heard of it. And what it is it is the anonymous contribution or expectation from each participant of the Fed where they expect short-term interest rates to sort of end at the end of this particular cycle. And you can see that blue dot by the end of 2027, many expect Fed funds rates to be at about 325, 350. Now, where are they today? Well, they're at 450, 475. So we do expect the Fed to continue to cut rates. Now, we don't expect a rate cut in July. Most of that has been taken off the table. When we do expect a rate cut is more in the fall, probably in September, very much like last year, and two other rate cuts in November and December. Next slide, please. So most importantly, what do we think? What is our outlook? Well, unfortunately, trade policy, and we are experiencing it this first few days of July, still will put some uncertainty, not only on earnings projections, but the performance of the market going forward. Again, this is one of those times where short-term news should not be used to make long-term investment decisions. That again, staying the course, being diversified, and continuing to focus on high quality are the key elements to long-term success. The U.S. economy, we believe, continues to remain resilient. That the U.S. consumer, which makes up about 75% of the U.S. economy, is still in fairly good shape and will continue to provide much of the resilience that we have seen over the past 5 years. And we do expect international to continue to do well. I know some think, well, it's just a fit and a start. We think it's more than the 4 quarters of 2025. And in fact, when you do start to see international outperform relative to the United States, relative to the US, and by the way, that's not saying that the S&P is going to have a negative return. It's more about relative returns. We think it's more of a 4 to 6 year period of time than anything else. So again, we do think that international can provide an important component to a portfolio, whether it is through diversification and managing risk, as well as adding positive returns. Next slide. Does it not want to go? So when looking at our own asset allocation views, you can see where we've sort of put our money where our mouth is and absolutely added to our international allocation. So in some of our most aggressive allocations, we're as much as 30% international. Now, I don't advocate that for you or suggest that for you, but we definitely believe in the international story today. On the US side, we are pretty much neutral to our benchmark, neutral to our long-term asset allocation for both large, mid, and small. On the fixed income side, we've actually reduced our exposure to corporate bonds. So fixed income that is issued by corporations and companies, and increased our position to a sector called securitized bonds. Now, these are bonds that are backed by assets, so mortgage obligations, asset-backed securities. And the reason we like these bonds in this particular moment is because they come with less credit risk that you experience with corporate bonds and less interest rate risk that you would experience with treasury bonds. And then lastly, we are slightly overweight alternatives, which does include things like real estate, private credit, different alternative strategies that provide the diversification needed in a well-rounded portfolio. So with that, I'm going to look forward to any questions or anything that has come up. I would love to take all of your questions.
Hey, Kelly, I have a quick question, and not advocating any specific stock, but you have Apple, you have Tesla, you have Coke. They are international. So when we say international, what are we really talking about for international stocks?
Oh, sure. And there is something to be said. People feel like with those companies, they can get global exposure. I think that I mean, when we talk about international, we're talking about companies that are actually domiciled outside of the United States. And I'll give you a great example. Yeah, I know you said, stocks, but a perfect example of a stock that has done extremely well relative to anything in the United States and even in international would be a company like Rolls-Royce. Now, I know people are thinking, what, the car company? No, actually, that is such a very small component of Rolls-Royce. In fact, they're one of the largest, if not the largest manufacturer of aerospace and military and defense. As Europe continues to build out or rebuild their military capability and defense capabilities, Rolls-Royce has been one of the biggest beneficiaries. So, Steve, it's actually about really giving yourself the opportunity to align yourself with some of the best companies in the world. But it's a great question because we get it all the time. And we think that, yes, you do get global exposure through a lot of US companies, but you also then get the opportunity to position yourself with some of the best companies in the world.
Not to hog the questions, but another, again, energy being near and dear to our heart here in Oklahoma. What do we see with energy and oil and gas going forward?
Sure, sure. Well, and it's a cat fight with the Middle East and the US as far as what the supply will be. Now, the Saudis, I believe, just increased supply, and that actually has sort of taken oil back down to what we think is kind of a neutral level of about 65 to $66 a barrel today. And so we will all depend on kind of what the swing factor is, and that is the US and what their supply capabilities will be going forward. I think everybody would be happy, Steve, if oil sort of landed between this 65 to $70 number, whereby everybody makes money. All of the horizontal drilling, even though the cost of getting a barrel of oil has gone up slightly over the past several years, it's still well above the break even. And I think the Middle East is happy with about $70. Do I see it going much below 60? Probably not. And do I see it going much beyond 80? No.
I got one for you. Kind of going back to those slides and the valuations on the S&P being so high, but interest rates a couple slides later were projected to go down. Where do you see this going forward? I mean, that to me doesn't sound like there's any possibility of a R word or recession, but like what are your expectations of the market?
So, interest, lower interest rates as a pricing mechanism to stocks, the lower the interest rate, the higher the price. And the same goes for fixed income. If you think there's an inverse relationship between the pricing mechanism of interest rates and prices. So, if interest rates were to go lower, we think that that works as a tailwind, certainly to stocks and higher prices, along with the expectation of that acceleration of earnings. And so, hand in hand, lower interest rates, higher earnings, better breadth. And I'll tell you, Dan, it is a great question because the thing is yes, the multiple is 22 times at or near an all-time high from a valuation perspective. But when you pull the covers back a little bit, you realize that there are 6 stocks that contribute over 50% of that extended multiple. And so and this is why, I think active management is a very important element in today's marketplace as well. Having somebody pick stocks versus just buying an index, because you do have all those opportunities outside of these 6 or 7. I think the 7th has been kicked out for temporary purposes, but you do have a lot of opportunity within the market that isn't overvalued, and that will take the market up higher as well. So it's really a matter of that E kind of catching up with all the rest of the stocks other than the infamous Mag 7.
Love it.
Kelly, we had someone, and I don't know if there was a specific question related to or just wanting your commentary on the big beautiful bill.
You mean the OBBB?
Yes.
Yes. So yes, and people say it with very different emphasis on it and different tones, but um, suffice it to say that it is very complicated and over 1,000 pages long. But I think the biggest question becomes, how does it impact me? Well, I think the biggest takeaway and the most important thing about the one big beautiful bill is that your taxes are not going up. So if you think about it, back in 2017, there was a temporary reduction, significant temporary reduction to taxes. That was actually sunsetting or going away by the end of 2025, which would have resulted in significantly higher taxes for you and corporations. Today, the one big beautiful bill made all of that permanent, so that taxes will stay at or will be slightly lower than they were before. I don't think we're going to see the significant impact that we saw back in 2017, but I think the one biggest takeaway for any individual is that taxes are not reverting back to what they were prior to 2017. Now, below the surface, there are some other things that actually could warrant a nice call to either Jamie or Steve regarding different tax planning issues, whether the estate tax has gone up, the charitable gift taxes have changed slightly. So it does give you an opportunity to maybe re-look at some of your future tax planning as well. But it really is about, I think, the biggest takeaway and the impact that it will have on us is taxes are not going up. Taxes are not going up.
Stole my thunder, Jamie. I was going to ask something along those lines next. Anyone from the audience? I mean, don't feel shy if there's anyone that has a specific question. We're happy. Kelly's a resource for you as well right now.
Anything, and every question is a good question.
What about NVIDIA? Do you see much more room for it to run, or have people kind of missed the boat already?
Oh my goodness. We don't typically comment about stocks, but that one in particular gets a lot of interest and traction. I would say that with the valuation that it currently has, it cannot do anything wrong. So with that comes a lot of volatility in the price of the stock. When I say this, so there's an old saying that goes like this: it's priced for perfection. So if it misses a percentage point in a margin or an earnings number, and by the way, it will slow. The growth will slow. What I always like to remind people is that today it is trading like it's never going to have any competition, and that's just not going to be the case. So, um, there was a gift back in April when it did pull back. And as I mentioned earlier, if you blinked, you missed it. But today, while it's hitting all-time highs, I would be a little more cautious about something like that, just because it is priced to, as I like to say, just priced for perfection.
I
It
have
does
a,
bring up a
oh,
good, well, I was just gonna say, it does bring up a good point, though, thinking about what is ultimately driving NVIDIA, and that is, of course, artificial intelligence. Dan and I did a call earlier this morning, and, somebody said, is that still going? And I said, well, it did get a little bit of a back seat to the first half when we were so focused on tariffs and taxes, inflation, and geopolitical events, that it did get a little bit of a break. But it's this is a powerful way to put this, but I think it's definitely warranted. It's going to change our lives, and it will certainly change the way in which companies are able to do things. But most importantly is the improvement in productivity, which drops right to the profit line. So productivity improvement means profitability improvement, which means better stock prices. So yes, I believe that artificial intelligence, we are just at the very beginning of what it can do, and it will change the way we do things. And I'm sorry, Steve, I
no,
interrupted you.
no, that's great. I was just going to shift gears and go to fixed income a little bit. I mean, I don't know. I've always, the canary in the coal mine for me is bankruptcies. If we see that increasing, then people are taking on too much debt. And I was just reading some article, like if a person is going to go into fixed income, where do we go right now? What are we looking at?
Well, fixed income, I would go, so quite honestly, I would go with a more tactical strategy, because the bond market is a lot of moving parts. And you can see, it includes things like US Treasuries, corporate fixed income, floating rate, which is bank loans, high yield, a lot of different moving parts. And so I like to look at strategies that are able to invest in any part of the fixed income. Let them make those decisions for me and go where the opportunity is. Today, as you can see in our own asset allocation models, we've underweighted corporate bonds, but overweighted securitized bonds. Again, those collateralized mortgage obligation, asset-backed securities, because with that particular part of the fixed income overall market, it does come with a little less credit risk and a little less interest rate risk. They're less subject to both of those risks that are found within the bond market. So this would be something on our platform to be specific. It would be something like a double line core that is primarily invested in those types of securities. So, quite honestly, Steve, I think that you have seen most of the performance for the bond market year to date. So when you look at the overall in benchmark, the Bloomberg aggregate, which is like the S&P for fixed income, it's up a little more than 3%. I think that's pretty much what you get for bonds this year. I think that, after 2022, where the bond market, the Bloomberg Ag was down 13%, many expected, kind of an about face and what we would refer to as an epic return in bonds that was similar to that of equities being up high single digits. I think because the Fed has moved so gradually, and in fact is now on hold, that we just don't ever really see that epic type return that many had expected. So I think you should expect from bonds over the next several years that sort of 3 to 5% that it has returned over the last several years, not including 2022.
And Kelly, kind of piggyback on that, we did have a couple questions, and one of the first one is kind of your thoughts on the covered call ETFs that are paying out some dividends right now.
Well, those are, we don't have a dedicated covered call strategy on the platform, except capital appreciation, T. Rowe Price capital appreciation, where he is able to write covered calls and generate additional premium and dividend yield. I think that dividends always play an important part of a diversified strategy in that they are like a safety net, right? You're always going to get some sort of return, even if the market is down. So I do like them, and we do have an opportunity to participate, not as direct as a covered call ETF, but through the T. Rowe Price capital appreciation, he does write covered calls on part of his equity portfolio. So yes, they have gotten a lot of traction and a lot of press lately.
And then we have another question, Tommy, just to your question too, is on the managed money side, we do use covered call strategies for our income models for our clients on that side. And then we got a question on your thoughts on opportunity and risk of cryptocurrency.
Oh, well, it's here to stay. It's absolutely here to stay. I don't know if it will be any kind of finite currency by the time I decide to go heels up, but I do believe that it is certainly um, not just an idea, not just an idea, but certainly will be something that is used and conducts business. Will it replace the dollar? No. But I do believe that it will certainly have a place going forward. I don't know a lot about it, just because here at Jackson, we can't invest in any crypto. We do, but having said that, we do have a strategy on Elite Access that does have a 3% position in Bitcoin futures. Now, that's as big as it'll ever get. It's actually the other 97% is gold and precious metals, which is also done extremely well. But we do have a small position in Bitcoin futures on our Elite Access, our investment only platform.
And one of the other questions too, and I think this is a good one too, is back to kind of the one big beautiful bill, is the mid to long term implications of increasing the federal deficit to the overall economy and investment strategy.
Oh, yeah, yeah. And certainly it does have implications to increase the deficit as a percentage of GDP. And that's the number you want to focus on. Yes, the absolute number of the debt is ginormous. But we are a ginormous economy. And what is more important to focus on is the percentage of debt to GDP. Today, it is over 100%, and the implications are that it could get bigger before it gets smaller. But many of, lower taxes, newer technology, just more growth initiatives are being set in place today to actually grow that denominator, grow GDP. And that's how you grow yourself out of sort of this percentage of debt. But, and this has been sort of under the radar, for the fourth month in a row, the deficit has declined month over month. So tax revenues have contributed to that. And certainly, so we are seeing, albeit very small, chipping away at that deficit number and that debt number. But it's really, I think, the things that are being put in place for the longer term are really the growth components that can grow that denominator and reduce that percentage of debt to GDP. At over 100%, I'll be the first to tell you that's not a sustainable position to be in. And we do need to do something. And I think that some of these things that were proposed in the One Big Beautiful Bill have that potential to drive the growth of the denominator and really GDP. Now, I know there are some people who think it can have the potential to grow as much as 5%. I think that's, and I'm one of the more optimistic people on earth. I think that's a little optimistic, but I certainly think we could get back to GDP growth of at least 4%. Yeah, thank you, Jamie. That's a good question.
And does anyone else, we probably have time for one more if there's any other questions? Okay, I'm not sure. There's Kelly, you have been wonderful as always, just a wealth of information to break everything down. And we so appreciate you spending the time with us today.
Oh, it's always my pleasure. I just think we're going to end the year on a good note. And I'm just going to reiterate again, it's all about staying the course, being diversified, high quality, and listening to your advisors.
There you go. I love that send off.
Awesome. Well, thank you guys. And thank you so much for attending. Like I said,